Top Trader Course. Top Trader Course. Advanced Stock Trading Strategies, the Trailing Stop. Most traders would probably agree with the proposition that the hardest thing to get right in trading is the placement of stop losses and take profit levels. A great deal of trading education and material that is shared with learning traders focuses on finding the right places to enter trades. Let's be clear that every entry is very important, but good trade management, i.e. using the right stop losses and take profit levels and changing these levels appropriately as the trade progresses, is equally important. The stop loss may be dynamic as a way to lock in profits on a trade that progresses profitably. However, the stop losses should only ever be moved in the direction of reducing losses or locking in profit. In this way, a trade that performs well will end up giving some profit. This is also a good way to let a trade die a natural death, instead of aiming for profit targets that can be very hard to predict. One example of a dynamic stop loss is the trailing stop. This may be set at a particular number of pips or based upon some measure of average volatility. The latter option is the better choice. Another example would be moving the stop loss level periodically, so it is just beyond major highs or lows or other technical indications. The beauty of this is that the trade stays alive as long as it is going well. When a long trade starts to break down through key support levels, then this type of stop is hit and ends the trade. This method is a way of letting winners run while cutting losers short. In trading, one can make a profit by short selling. A short or short position is a directional trading or investment strategy where the investor sells shares of borrowed stock in the open market. The expectation of the investor is that the price of the stock will decrease over time, at which point he will purchase the shares of the open market and return the shares to the broker from which he borrowed them from. While getting into a short position is usually done with stocks, the same logic of the trade applies to other types of assets, such as stock options, exchange-traded funds, commodities, and currencies. Short selling puts the investor into a position of unlimited risk and a capped reward. For example, if the investor enters into a short position on a stock trading at $20, the most he can gain is $20 less fees, while the most he can lose is infinite, since the stock can technically increase in price forever. Short selling is one strategy to use if you believe the price of the underlying asset will decrease in the future and you want to profit from that loss. Let's discuss the double tops and bottoms patterns. In this image, we can see the example of a double top pattern. Double tops, or the M formation, and bottoms, or the W formation, are reversal patterns. A double top signals the price is no longer rallying and that lower prices are potentially forthcoming. A double bottom indicates the price is no longer falling and the price is heading higher. Double top forms when the price makes a high within an uptrend and then pulls back. On the next rally, the price peaks near the prior high and then falls below the pullback low. It's called a double top because the price peaked at the same area twice, unable to move above that resistance area. The pattern is complete. Traders may take short positions or exit long positions when the price drops below the pullback low. For example, if the price hits a high of $50, then pulls back to $47, rallies to $50.05, then drops back below $47, the price is complete, and that could indicate the price will continue to drop. A double bottom forms when the price makes a low within a downtrend and then pulls back to the upside. On the next decline, the price stalls near the prior low, then rallies above the pullback high. It's called a double bottom because the price stalled in the same area twice, unable to drop below that support area. The pattern is complete, and traders may take long positions when the price rallies back above the pullback high. For example, if the price drops to $47, pulls back to $50, drops to $46.75, then a rally back to $50 signals the price will continue to head higher. Not all traders are interested in taking positions on a chart pattern breakout. Even so, the double top or bottom pattern still alerts traders when they may wish to reconsider their long or short positions. Another reversal pattern is the Doji candlestick, which forms when a security's open and close are virtually equal for the given time period. A short squeeze is a situation in which a heavily shorted stock or commodity moves sharply higher, forcing more short sellers to close out their short positions and adding to the upward pressure on the stock. It implies that short sellers are being squeezed out of their short positions, usually at a loss, and is generally triggered by a positive development that suggests the stock may be embarking on a turnaround. Although the turnaround in the stock's fortunes may only prove to be temporary, few short sellers can afford to risk runaway losses on their short positions and may prefer to close them out, even if it means taking a substantial loss. A short squeeze is a big risk associated with short selling. If a stock starts to rise rapidly, the trend may continue to escalate because the short sellers will likely want out. For example, if a stock rises 15% in one day, those with short positions may be forced to liquidate and cover their positions by purchasing the stock. If enough short sellers buy back the stock, the price is pushed even higher. It is highly recommended using a stock screener for an in-depth and updated perspective on the market status. A stock screener is a tool that investors and traders can use to filter stocks based on user-defined metrics. Stock screeners, such as finviz.com, exist either for free to a subscription price on certain websites and trading platforms. They allow users to select trading instruments that fit a particular profile or set of criteria. Some trading platforms and software allow users to screen using technical indicator data. For example, one could filter for stocks that are trading above their 200-day moving average.